Welcome back. We have seen some spectacular results, second quarter results from the banking sector, both private sector banks as well as public sector banks. Hardly any exceptions to that. But how long will the good run continue, both in terms of quality of assets and in terms of profitability, is what we've been discussing with Ashish Gupta of Credit Suisse, NS Vishwanathan, former Deputy Governor of RBI, and Vardhan, the independent banking consultant, formerly from BCG. Gentlemen, thank you for your patience. Mr. Vishwanathan, I wanted to know if in public sector banks you notice, any institutional change. After all, that's where we saw the return of NPAs to the same level that they were in 2001. But now there are institutions like CRILIC and probably some sensitivity at the government end as well. Do you think things are different with PSU banks?
So I think I just want to continue make a point on the earlier discussion. If you see the delta in the net profit of banks for Q2 of this year vis-a-vis last year, they have been largely due to higher NIMs, again due to higher interest earnings on the one hand, and number two, lower provisioning. Okay, both these are the two factors that resulted in the net profits being much higher in the current quarter, last quarter of this year than vis-a-vis last year. Now, all these to stay, it's important that these are not happening due to factors purely external to the banks. It's also happening because banks have internalized a lot of processes. So I used to keep saying, for example, that even when the banks, when I was in the bank, banks were joining the personal loan segment bandwagon. I used to say that, it's not a bandwagon to join. There must be processes in place. There must be back offices, which kind of are able to address asset quality, credit appraisal and things like that. So I think the banks, in my opinion, I've been out of the system for the last 2 years, but I think if you ask me, the CRILIC is an important mechanism because I think unlike a credit information bureau, the CRILIC data is of a lot more value to the banks on the one hand, and number two, I think the recovery system that has been put in place, which is the IBC, and some of the the governance reforms like moving the chairmanship to a non-executive person in public sector banks. All these things will have institutional frameworks in place. But I think I'm not too sure. So it's very difficult to take a view as to whether this will continue for 10 years, for anything for that matter. But obviously, certain reforms which are external to the banks, like the IBC, the CRILIC system, are there. So that is not in their hands to make a mess of.
I get
so all this internal, maybe they can loosen the appraisal standards. They can. Those things might happen.
Yes.
But the external systems which are helping the credit quality in particular, those are there to stay. And I'm also seeing that the government and the authorities are keen to fix whatever flaws are there in the IBC so that it becomes an effective mechanism. So I think if you remember, in my speech on the February circular, which unfortunately got flashed later, I had talked of, it's no more business as usual.
Yes.
Essentially coming from the fact that there is an IBC which is a kind of a backstop to prevent, I would say, over borrowing, over leverage by corporates, because then they have the fear of losing their enterprise.
One hopes by then there will also be enough of vulture funds and perhaps marketized sale of NPAs. We are moving in all those directions.
An important thing, I think. Sorry, Lata, one other important thing which I want to mention is a point I think which Harshvardhan also mentioned, which is that there is clearly a change in the asset composition, loan composition.
Yes, fair point.
So the borrowings coming from the personal segment, so consumerization, as we said, it's the consumer credit that is driving rather than lending to the industry per se.
Yeah,
okay.
Actually, on that, I wanted to...
The fact that even after the pandemic, that has stayed. Because that's the time when people lost income.
Yes.
That has kind of remained stable. It's a good thing to kind of mention.
Yes, fair point. Actually, again, going back to the SBI chairman, he told us that he is more sure of his unsecured credit than even his secured credit because of the AI that they have been able to put in. Mr. Harshvardhan, any thoughts on that? That although unsecured credit is growing, would you say that technology and AI and these kinds of help could lend a lasting improvement to the banking system?
My own view that this would perhaps vary across banks because some banks may be using it. But a lot of it is just, for example, as Mr. Vishwanathan said, a lot of the external things. The credit bureau coverage has improved a lot. They cover far many more people now than they did even 5 years ago. And people are aware of not spoiling their credit scores and so on. So I think those factors have also played in. But nevertheless, while these are all fixed rate loans, as Ashish said, look, inflation pinches into household budgets. That's and right. Savings are going to fall. So we'll still have to watch out. The other point I'll make, going back to what you asked, Mr. Vishwanathan, is that, despite all the things that we said, there is still significant risk aversion in banking. Risk-weighted asset to total asset ratio is still at 54% as of the last quarter. It was 70% 10 years ago. Banks have just far more risk averse right now.
Yes.
And that, to me, in the long run, if the capex cycle, etc., were to return, is not a good signal. Ultimately, banks have to take risk, right? Otherwise, who will provide credit in the economy?
No, I should be doing this discussion when there is euphoria, not when there is fear. Probably, you never know, in the next 3-4 years, we could be euphoric that India is the only game in town. You never know. Ashish, actually running out of time.
Honestly, sorry. Yeah, sorry. No, that can't happen on the back of consumer credit alone. We are not at the stage of our development where banking becomes consumer banking entirely. Somebody will have to fund capex. And I don't know where it will come from with this level of risk aversion.
Yeah, so that's a macro problem to worry. How will we fund the capex? Ashish, actually, a couple of questions. I'll try and squeeze them in. Would you bet on PSU banks now because they never got a very high price to book anyway? Is it time to give them more credit for a couple of years? As well, if you can manage NBFCs, should they also not be beneficiaries? But we don't see them, at least in the stock markets.
Sure. So I think on the asset quality front, what we are seeing is a case of rising tide lifts all boats, right? So you're not seeing the improvement just in private bank, you're seeing it in PSUs, you are seeing it in NBFCs, right? I think where the NBFCs are probably struggling is on two counts. One is a lot of banks, as you mentioned, even some of the public sector banks have improved their distribution, their use of technology, and are competing more effectively against NBFCs because NBFCs were much better in distribution. So while they had higher funding costs, because of better distribution, they had a more significant share in certain consumer loan categories. And I think banks are making inroads there. The second is the macro environment. What is the market expectations on or concerns on how the liquidity will pan out? And this means that there is not as much optimism on growth for the NBFCs being as fast as it is for the banking sector. So I think that is one reason, even in our investment strategy, we prefer banks to NBFCs.
Yeah. A very quick answer on PSUs. Do they look good for a 2-year bet?
Sure. So I think certainly in terms of performance, and we talked about it earlier, that ROAs and ROE improvement for PSUs is not just a one-quarter phenomena. It will continue to last. I think, but even within PSUs, you will see increasing amount of differentiation. You will find some of the PSUs, even with this improvement in margin and drop in credit costs, are not generating enough capital to be able to grow, right? And particularly in the Indian market, we find growth to be an important driver of valuation. So PSUs who are now able to deliver ROEs that will help sustain the growth will do better compared to PSUs where you will need equity probably 12 to 18 months down the line, although they look comfortable for capital now because ROEs are still single digit. they will not be able to sustain this pace of growth without needing capital. So I think you will need to differentiate among the PSUs.
Okay. Thank you very much, gentlemen. I tried to fit in a lot. Key takeaways, the good times in terms of ROAs, profitability, and in terms of bad loans or lack of them is likely to continue for a good 2-3 years. Perhaps margins peak off by the end of this year. For the banking system as a whole, there is some long-term improvement because of institutions like the CRILIC, which is a database of RBI, where banks have to weekly report loans that are in default, and things like the IBC. So some long-term health of the banking system is also ensured. That's the key takeaways from our guests. Thank you very much for watching this edition of Indianomics.